I'm looking at that graphic, and I saw your note, saw your tweet. It looks more like the EKG of a morning news anchor when the alarm goes off. What exactly are we looking at right here?
So often when market forecasters look at the yield curve, they're often referring to one yield spread, like the difference between the 2-year and 10-year yield. But what I like to do is look at all of them. There are 91 different yield spreads, looking at the spread of every shorter maturity treasury to an active longer maturity treasury. So rather than just picking one yield spread, looking at the entire curve tells us a lot more about how the whole curve is inverted. Now, more than half of the yield curve, as you can see in the past, has inverted ahead of prior recessions. And as of this morning, we just crossed over 51% of the yield curves are now inverted.
And when we get that, so normally we look at like 2-year, 10-year, and what do they joke around? Inverted yield curves have predicted 10 of the last 7 or whatever recessions. They're not, there's no perfect indicator, and this is not. But what is the fact that all of these maturities, half of those maturities across the entire thing, that they are inverted? Does that tell you that there is a recession coming, or maybe there's, for lack of a better term, because it's early, just some funky stuff happening in the bond market, Jeff?
Well, I think that the high risk of an economic recession isn't new news to investors, right? I mean, we've been in a bear market. We've recovered a little bit in July, but this isn't new news. The yield curve could be signaling, however, an earnings recession. This is almost always true. Whenever the yield curve gets this inverted, we tend to see earnings begin to fall. Analysts continue to see earnings growth in the quarters ahead. Very unusual. So I think an earnings recession signaled here by the yield curve could make market PEs look higher than they appear to be right now.
Jeff, I don't know if you have kids, and if you do, how old they might be. But if you did have kids, you might remember the days when you're driving and it's, are we there yet? Are we there yet? Are we there yet? You remember that? My guess is now, with all the affection you have for all of your clients out there, that you're kind of getting that treatment. Is it a bottom? Is it a bottom? Is the bottom in? Are you getting that at all? 1,000
we are
times
getting
a day?
1,000 times a day, pretty close, times 100. I think we can't really count on any kind of bottoming process until inflation begins to show signs of peaking. This Fed is not going to stop hiking rates because they anticipate inflation to decline. They're going to need to see it decline and react to it in hindsight. We've seen, I think, the peak in commodity prices, right? That happened a couple of months ago. But inflation's a process. Not all prices peak at the same time. So that's usually followed by goods inflation. We may be there now with the excess inventory at manufacturers and retailers. They might begin to discount today. But looking out to services prices, services make up almost 60% of the CPI. They usually don't peak for 2 to 4 months after the peak in goods prices. So we might be looking out to late this fall, early winter before we can actually point to a peak in inflation, when the Fed can begin to slow its pace of interest rate hikes or maybe even pause them. That's the key signal, I think, for the stock market to stop going down. Could still be a little ways away. That's why I think looking at high dividend paying stocks might be the solution.
Yeah, the dividend payers, the high quality stocks. And let's remind our audience that equities tend to go up, about 75 or 77% of the time. There's a reason people get rich in the stock markets, because it works, and you got to buy when it's the most scary, correct? Long term.
Well, absolutely. I mean, I think a long-term focus is very important here, and the depth of this potential recession, even in earnings, may be fairly mild. I think investors looking to protect from a return to a recessionary market environment just temporarily here may want to focus on high dividend paying stocks. In every recessionary bear market of the last 50 years, high dividend paying stocks have outperformed the overall market. The S&P 500 high dividend index is actually positive this year. We know the overall index, the S&P 500, is down double digits. That's also true in Europe. It's also true in Japan. So we're definitely seeing a preference for high dividends here. They can offer some protection in an environment where earnings could be headed lower.